The Kenya Bankers Association says there is no vacuum as far as risk-based pricing for loans is concerned, even as the banks continue to engage the market regulator for guidance. Chairperson John Gashora says that banks continue to use a form of risk pricing in extending loans, with ongoing engagements with the market regulator seeking to provide clarity to customers on how the pricing is being done. Ever since the cap on interest rates was repealed in November 2019, the form of pricing adopted by banks across various risk profiles has been a matter of great interest among stakeholders. Gashora says the fact that the banking sector loan book continues to grow is evidence that banks are lending even as they await guidance from the market regulator.
First of all, I do want to clarify something, that each bank today uses some form of risk-based pricing. I think there is a misconception out there that banks are not using risk-based pricing. We are. And in fact, if you look at customers, for example, large corporate customers don't pay the same rate as the small SME. Yeah? And the small SME don't pay the same rate as the individual. And even individuals, depending on the relationship with the bank, don't always pay the same rate. So at each level, there is some form of risk-based pricing. The work that we're doing with the CBK, and what CBK wants to do, which I think is very, very noble and important, is to say all of you have different models, and your models are too complicated for the ordinary customer to understand what you're doing. Therefore, when I come to a bank and tells me I'm being charged 16%, and I go to another bank and I'm being charged 13%, I don't understand the difference. So what they're asking to do is, let's understand the models to the point where we can disclose these models to customers.